Gen Z isn't idolizing Nike the way millennials once did. For them, it's less about legacy and more about aesthetics. They're chasing style, something Nike hasn't consistently delivered in years. Right now, Nike isn't leading on comfort either. Brands like Hoka, Asics, and New Balance have raised the bar so high that Nike feels like it's playing catch-up. In running, it's barely in the conversation, with Brooks, On Running, and Adidas dominating the space. The same story plays out in hiking, where Salomon and Merrell have taken over. Even in casual wear, Nike is losing ground to Keen, Blundstone, and Timberland. A big part of the problem is design fatigue. Over the years, Nike has leaned too heavily on recycled ideas, overworked silhouettes, and hype drops that feel increasingly diluted, smaller, messier, and cheaper than they used to be. That's why you can argue the brand sits in an awkward middle, too common to feel like luxury, yet too expensive to be truly accessible. The irony is that Nike products still command premium prices, and consumers are paying top dollar. To be fair, they're not standing still. New initiatives like Nike Mind signal a push toward innovation, and the partnership with Skims shows they still know how to tap into culture. That alone proves Nike remains a giant. But when you compare 5-year sales trajectories, brands like Asics, On Running, Hoka, and New Balance are clearly outperforming, while Nike appears to be losing momentum. So how did it get here? Is this the beginning of a slow burn decline like Kodak or BlackBerry, or does Nike still have the ability to adapt and stage a comeback? Nike has long been a global icon, responsible for legendary product launches and unforgettable ad campaigns. From Air Jordan to high-profile athlete endorsements, the brand once defined cultural momentum. But in today's consumer landscape, it's struggling to maintain that same lift. The numbers reflect the shift. Nike stock has fallen roughly 53% over the past 5 years. Return on equity has dropped significantly, from 43.1% in 2022 to 23.3% in 2025. Quarterly gross profits have also trended downward since 2023, signaling deeper structural issues. So, what went wrong? At its core, it comes down to innovation, or the lack of it. Leadership plays a role, which we'll get into later, but the simpler truth is this. Nike slowed down on pushing new ideas because consumers kept buying the old ones. Classic Jordans continued to sell at scale, reducing the urgency to evolve until the market moved on. They leaned hard into hype, manufacturing a sense of scarcity by limiting production, funneling sales through their own app and pulling sneakers from retail stores and longtime partners. Much of this strategy took shape under the previous Nike CEO, a former consultant with a tech-first mindset. He successfully turned Nike into a digital DTC powerhouse, but in the process, the company neglected the fundamentals: product innovation, brand storytelling, and the very elements that originally set it apart. That lack of innovation became increasingly visible, especially in seasonal drops. Instead of pushing footwear and athletic wear forward, Nike leaned heavily on reissuing legacy designs, recycling signature styles rather than evolving them. At one point, resale demand, like the frenzy around the Nike Dunk Low Panda, had people paying multiples of retail. Nike saw the opportunity and tried to capture that upside by flooding the market with scarce models. For a while, new colorways kept the momentum going. But eventually, oversaturation set in. Dunks and Jordans became ubiquitous, and with that, exclusivity faded, and so did the desire. Over time, this eroded Nike's dominance, especially in running and everyday wear. While brands like Asics, Saucony, New Balance, and Brooks surged in popularity. Asics and New Balance in particular stayed consistent, quietly releasing high-quality products, both new designs and thoughtful revivals from their archives. As Nike lost momentum, collaborations across the industry picked up, and these brands capitalized on the opening. They now command serious influence across both wellness and fashion, and ultimately, that's a win for consumers. After years of recycled styles, the market has shifted toward variety, quality, and genuine innovation. As hype evolved, so did expectations. Many consumers chasing the next wave realized they didn't have to sacrifice comfort for style. They could have both in their footwear and clothing, something Nike had increasingly struggled to deliver. Like many apparel companies, Nike is highly exposed to tariffs due to its reliance on a global supply chain to import shoes into the US. During its September 2025 earnings call, management projected that tariffs would cost the company around $1.5 billion in fiscal 2026, trimming roughly 1.2% off its gross margins. When Nike reported its second quarter fiscal 2026 earnings on December 18, 2025, it actually beat analyst expectations on earnings per share. But the market reaction told a different story. The stock fell 10% the following day. The drop was largely driven by weak performance in China, where revenue in the Greater China region declined 17% year-over-year. Analysts see this as a warning sign. China has become a critical growth engine for Nike, and if demand from Chinese consumers continues to weaken, it could significantly limit the company's future growth trajectory. They could offset some of that pressure through sport, but it looks like they've lost focus there too. Nike once dominated tennis, operating it as a dedicated division with its own designers for apparel and footwear. Around 2019, that division was folded into a broader sports category, and the identity started to fade. The lead shoe designer eventually moved to Jordan and later left to head footwear design at Wilson Sporting Goods. You can see the shift today. Nike's presence in tennis has been tapering off, with Grand Slam releases feeling increasingly underwhelming, often marked by uninspired design and inconsistent color palettes. At the same time, competition has intensified. Brands like On Running, Anta, and Li-Ning are stepping in with fresh energy, creating pressure Nike didn't have to deal with before. At its core, Nike still wants to position itself as a premium label, one that can charge full price without hesitation. But today's consumer is far more selective. Shoppers are increasingly price-sensitive, especially when it comes to footwear. Data from the Footwear Distributors and Retailers of America highlights this shift. In October 2025, a survey showed that 48% of U.S. consumers weren't planning to buy shoes during the holiday season, while 65% of those who were pointed to tariffs as a key driver behind rising prices. If prices continue climbing, price-conscious consumers may simply opt out. That puts Nike in a difficult position, losing pricing power while margins come under pressure. At the same time, it's facing competitors offering products that feel fresher, more stylish, and better value for money. The market has already started to reflect this reality. Nike has shed more than half its market value since the COVID era, and without a meaningful shift in strategy, the downward pressure doesn't look like it's easing anytime soon. John Donahoe, who led Nike from 2020 to 2024, played a significant role in the brand's recent struggles. Under Donahoe, Nike leaned into leadership that lacked deep roots in sneaker culture. With a background in consulting and tech, he had little hands-on experience in retail, particularly at the store level. That disconnect showed. The company underestimated the value of key wholesale partners like Macy's, DSW, and Foot Locker, all of which had historically been critical in driving visibility and sales, especially in running. Instead, cost-cutting became a central lever, a familiar consulting playbook that ultimately compounded Nike's deeper issues. By contrast, his predecessor Mark Parker had a much stronger grasp of what made Nike resonate: design, product innovation, and brand storytelling. In October 2024, Elliott Hill stepped in to lead a turnaround. A lifelong Nike insider, Hill understands the company's DNA and was part of its most successful era. While that doesn't guarantee a comeback, early signs are encouraging: stronger product direction, more compelling creative, and renewed cultural relevance. The initial partnership with Skims is a clear example, and more collaborations are likely on the horizon. Hill's strategy is essentially a reset. He's working to undo the previous leadership's heavy push toward discounted, direct-to-consumer e-commerce, and instead rebuilding relationships with wholesale partners, restoring Nike's presence on physical shelves, and reconnecting with the retail ecosystem that once fueled its dominance.